people are always trying to divine messages out of the level of the VIX or the fear gauge, they often like to refer to it. It's very important to understand what the VIX is, because if you don't understand what it is, it's impossible to know what it's telling you. The VIX, as it's constructed, is roughly a rolling 30-day implied volatility of S&P SPX index options that trade on the Chicago Board Options Exchange. What they're doing is they're taking options that have maturities, I believe, 23 to 37 days, but roughly call it an average of 30-ish. And they take those implied volatilities, which is the price, effectively, that option traders are charging for options at the moment, and they're then using that as created an index out of that, and that's where the index comes from. So it's first of all, it's not like a stock index, because it's an index. It's really a second order index when you think about it. It's an index of volatilities of options that trade on the benchmark S&P 500 index. So you're out a little bit of a ways from the actual index itself. And while it's certainly connected to the S&P 500, it has very different qualities in terms of the way it moves and the way it reacts. So knowing that what it is it's a 30-day rolling measure of implied volatility, that means you're always kind of looking a bit forward. So even if the index is at some level, call it 13, what it's really trying to say is that the implied volatility over the next 30-day period is going to average about 13. And that leads you into another difficult thing to understand. 13 is an annualized number, but yet we're talking about a 30-day period. So it's sort of meaningless when you think about it. What does 13 annualized mean if I'm trying to think in terms of a 30-day period? And that's where option traders get into what they call the rule of 16. The way that we take annualized numbers and convert them to daily numbers, or vice versa, is to adjust by the square root of the business days. Fortunately, the square root of business days in an average year is just about 16. There's just around 256 business days in a year, which is 16 squared. So option traders get very good at multiplying and dividing by 16. So we'll use 12 because it's an easier number than 13. But if you take a 12 annualized volatility and convert that to daily terms, divide by 16, you're talking about 0.75%. And that's meaningful in the sense that we would hope, if you're let's say buying options, and this is a generic term, not specifically to VIX, but if you're dynamically hedging options, what this is saying is that the options are going to decay at a rate that corresponds roughly to 0.75% per day. So if you can get enough movement by buying and selling shares or index or ETF or around it, you would need to sort of see that kind of 0.75% of a day movement to break even, basically. And so the trade would be, if you see that the index is going to be, if you think the stock, let's use stock terms in this case, if you think the stock is going to be more volatile, moving around 1.5%, and you're buying it at 0.75%, and you're dynamically hedging, that's a chance for you to make some money. If you're the writer, it's the opposite. And so that leads us back to the next leg of the stool, which is historical and realized volatility. Historical volatility is backwards looking. You basically take a look backwards, and over a period of time, 7 days, 30 days, in this case 30 days corresponds to the VIX, and you look and see over that time what was the realized volatility. What did the index or the stock actually do over that time? And right now, where we're seeing VIX in the low teens, we look back and see the historical volatility, 30-day rolling, in that measurement as being in the high single digits. So right now, that's benefited option writers rather than option buyers. That's a fairly normal state of affairs, because the option writers, with the exception of covered calls, you really don't see much natural writing of options. For the most part, an option writer has to be incentivized to do so, particularly out of the money puts. And so that gets into why you would see implied volatilities above historical volatilities on a normal basis. That's sort of the normal state of affairs to incentivize writing. And so right now, with VIX in the low teens and historical vols in the high single digits, you're seeing what I would say is a fairly normal state of affairs. Somewhat elevated volatility over historical, and then that would be the incentive. The next leg of looking at VIX would be you look at the Vix Futures Curve, and like a yield curve, it's typically upward sloping. It's similar construction. You're taking the sequential futures, rolling them out, looking at the prices, and when you look at them graphically, you sort of get that normal sloping VIX curve that looks like a normal yield curve. Right now, the VIX curve is showing it to be a bit more steep than the bond yield curve, which is notoriously flat right now with a very tight spread between 2 and 10 year. VIX doesn't go out that far. VIX is really looking a few months to a couple of years out. But you're seeing that nice normal upward trend. We did see the inverse of that, backwardation as it's called, at various points of stress this year. February, March, we saw a few other instances when we had hiccups throughout the spring and early summer. And that is what you see there is that option writers need an extra incentive to write their options. There's heavy demand for volatility, for the protection offered by volatility, and the writers need some extra incentive to do it. Same reason if you're selling umbrellas, there's a lot more demand to do so on a rainy day than there is on a sunny day. And basically when it's raining in the equity markets, the price of umbrellas, the hedge, gets more expensive. And so that forward sloping yield curve that we're seeing right now, it's relatively steeply sloping in the short term. That's because while markets may or may not have a memory, market participants do. And many market participants remember that while seasonality is no guarantee, late August, September, early October into mid-October can be historically volatile times. And people who write options like that extra protection, people who buy options find that they might be more inclined to hedge over this time period. When it's, you've had a good year, if you've got gains, it's an opportune time to lock it in. People who work off of bonus pools or performance like to lock in their performance. And you start to see people get a bit more skittish. This year, 2018, we have midterm elections that will be unsettled possibly into early November. And so you're seeing this sequential increase in the implied volatilities out through that time period. So essentially, hopefully that was a good primer. But as for how to understand VIX in a historical context, but the short answer to the question is, what is VIX telling us? Not a ton actually right now. It's telling us that historical volatilities, the market has been relatively not volatile, and that may persist through the vacation period that we see in July and August. As we get into the fall, the market is telling us that it's looking for potentially a pickup in volatility, but not panicky about it, not telling us so in a manifest way. But what hopefully your takeaway from this is an understanding of the VIX index, an understanding of implied and historical volatilities. Very brief primer on implied and historical volatilities. It's a very rich subject that we can spend hours on. And looking at the interrelationship between implied volatility, historical volatility, and the VIX futures curve, and try to use that and see as these markets move, is there anything that the market's telling you going forward that it may not be telling you now?